All right, everyone, thank you so much for sticking around. I am incredibly excited to moderate this next discussion featuring two financial veterans who bring over 3 decades of experience to the table. Please join me in welcoming John Feneck, founder of Feneck Consulting and a seasoned coach and manager of financial advisors. And alongside him is Mike Chadwick, president of Fiscal Wisdom Wealth Management. He's helped hundreds of clients navigate markets across all cycles. So thank you both so much for being here. And I'd like to start with you, John. How long have each of you been in the financial advisory arena specifically, and what initially would you say drew you to this work?
Money.
Well, we need to be honest.
1992, I started at Merrill Lynch, and I was poor growing up. So yes, I looked at finances, 100%. I was going to get there somehow. And at 21, I was lucky enough to get into Merrill Lynch and work my way up. And so yes, I mean, I've had a license since 1992 that I gave up a few years ago because now as a consultant, I don't need it any longer. But I've been in the business 33 years.
Okay, fantastic. Well, thank you for that. And Mike's still laughing at John's comment.
That's this morning. So mine's a little bit different. I'm actually a reformed engineer. So I started my career as an electrical engineer, and I love the math aspect of that, but I hate being in a cubicle not talking to human beings. So I kind of decided I'm not going to do the engineering thing, and then I found financial planning to be a perfect mix because I get plenty of math exposure, and I get plenty of social exposure. So for me, it's a great fit. And I've been in the finance business for 31 years this year.
You'd never know it by looking at you, I'll tell you that, unless you started when you were 5. Well, okay, so let's get down to the dirty. So despite obvious macro trends, financial advisors are still seriously underweight in metals and mining. And why do you think that is?
I'll take that first. And Mike, as a current FA, might have a different opinion, but I think that coming from my background where I was working with mostly Merrill Lynch advisors for many years, Merrill is a huge firm, right? And now that's B of A, and they would say, hey, you got to sell credit cards, you got to sell mortgages, you got to do all these things that an average advisor doesn't want to do. And then you've got to manage money. So I think from a client perspective, you think, well, this guy or this woman is going to help me with my financial goals and my retirement. But it's not just, that's not what they do. They have to do so many other things. And there's sprints they have to hit and like requirements and then staying on top of your regulatory requirements, meaning your continuing ed. The life of an average FA is extremely challenging, I would imagine, in 2025. But when I was working with most of FAs from 1996 to 2019, the challenge was very real then too. And so I think more and more firms now, like Morgan Stanley, UBS, the big boys, are moving advisors towards what I call glide paths, where they basically put clients into, they fill out an elaborate risk questionnaire, and then based on your answers, you get put into a bucket. I mean, I'm just being blunt, because this is what really happens, and that's why I like working with advisors like Mike that think outside the box, because it's not just one size fits all. It's, you have to, but at the wirehouse level, the bigger firm level, you're seeing more and more advisors do 2 things. 1, do the glide path thing, meaning model portfolios, and 2, drawing the line in the sand at a higher dollar amount. Like, we won't pay you if you don't have this much AUM, Mr. Advisor. So there's no incentive for that advisor to work with a client.
And Mike, what would you say there?
I agree with what most of John said, but I would also add that we're in a world today where everyone is kind of chasing performance. So, the American tech has done so well, Bitcoin's done so well, people just chase what's doing well. So whether it's a separately managed account, whether it's a popular mutual fund, all those things today are littered with the same securities. And there's really not a lot of diversification. So from my perspective, risk is grossly mispriced. These things are definitely in bubble territory. They're not going to stay here for long. I have no idea when it ends, but I suspect it's going to end badly for a very long period of time. And I'm a value guy, so I just view it with the mispricing of risk. I don't want my clients' assets being in those places, so I try to find things that are cheaper. And I've spent my entire career chasing sectors that have been destroyed, looking for the turnaround, and that's kind of how I found this industry. I'm not a sector guy. I've been in it for a couple of years now, and I think it's amazing. I think the runway coming out of this is going to be phenomenal. So I'm excited to be here.
All right, terrific. Thank you for that. And For those, I noticed that we have, two major investors who have been here for the entire day panel, really interested in what it is that we have to talk about across the spectrum here with all the different conversations we've had. So I think it would be helpful for investors that are watching, what kind of advice would you give to other, say, financial professionals who may be hesitant about specifically incorporating mining and metals equities into their portfolios? What would you say, and how would you help them navigate that?
So when I worked for Sprott in 2016 and 17, my job was to run half of U.S. distribution for the company, and that meant going to big offices like Merrill Lynch Beverly Hills, UBS San Francisco, doing meetings at the front of the room, and then walking away with business cards from those people that expressed interest. And usually if you have 50 people at a lunch, maybe 5 people knew what you were talking about and 2 people might actually buy something. I mean, this is 2016. Gold's at 1,100. And I would say to people, look, when you sold something, you would say, well, thank you so much, Mr. Advisor, for that business, but you're only putting 1% in gold. Like, do you really think that's going to hedge anything? Because it's not. And that's what I think most advisors that are not like Mike are positioned right now. They have a 1 to 5% position in commodities or gold, and they think this is going to somehow help the downside risk in their portfolios, and it's hilarious because it's not. This is something where we're in a new cycle right now. There's a new paradigm. Gold is leading the market. Look at the S&P return year to date, and look at the gold return year to date. This should be telling you something as an advisor, and you have to be pivoting to something new, and it's always hard to learn new things. But there's a number of ways to get exposure to the commodities markets. It's not just about gold, it's about silver, copper, you name it, but the average advisor needs to do more to learn about our sector.
Terrific. And Mike, I'd ask you as well.
Yeah, I think there's an educational gap here. In our business, what happens is we're kind of force-fed this generic prescription of do what everyone else is doing, which is the same old thing. It's the popular mutual funds, separately managed accounts, buy what does well. Everyone buys investments based off a performance record the last 10 years, last 15 years. And all those numbers look amazing when you're looking at tech or crypto or anything super aggressive today, especially American equities. However, there's cycles in the world. And I feel like we're in a period kind of like 1999. I saw this in 99. And I didn't know much about the metal sector, so I kind of hid in oil. And they did well coming out of 99 while the NASDAQ got ripped and the average consumer got destroyed. So I think we're going to have a similar outcome here. But I think advisors need to be educated as to how the cycles work, how valuations work. I mean, in tech, the average advisor's got clients in portfolios at 30 times earnings. And these companies' earnings are decelerating. Sometimes they're going negative. So that doesn't make any sense. In a sector like this, you can buy things at a discount to book. There's just not enough risk there. So I think the advisor needs a level of education, just like the public does. And our business is kind of set up on autopilot, which I wish it weren't. And I wish we had higher levels of entry, higher barriers to entry, similar to medicine or law. We need that, and we really should have that because, quite frankly, a lot of people are just kind of doing what they're told. Most of my peers are not students of the market. They're great relationship people. They're great at helping people manage their emotions and their behaviors, but ultimately they don't really understand how markets work and what's likely to be the outcome from here.
Sure. And so for investors, watching, listening, trying to learn how to navigate this landscape, what would be your best piece of advice for them?
Investors.
Working with financial advisors.
Yeah. So your average FA is not going to do anything for you in this sector. I'm just being blunt. I mean, again, a 1 to 5% exposure to what I consider to be the best new sector in terms of performance for the next 1 to 3 years, I mean, you're going to miss the boat. So you have to think about challenging your advisor to say, well, tell me about why is gold up so much and we have 0% weight? That's a normal question I would be asking. Now everything's high, in hindsight it's 2020, but silver at $32 an ounce right now could easily hit 50 in my opinion next year, which is the all-time high, which is implying almost a 40% return. So in a challenging market, which Mike is talking about, why wouldn't 40% returns over the next 12 to 18 months be attractive, right? And so these are the things that investors need to ask of their advisor. And if they don't get the answer they want, they need to work with someone like Mike as a second advisor, right? That can help them with that piece of their portfolio.
Excellent.
I would agree with that. I would also add to that, you got to ask the advisor about the valuation. How much are we paying for our portfolio? Are we trading at an average multiple at a discount? I mean, like I said earlier, a lot of equities are trading at 30 times earnings. Some are trading at 30 and 50 times sales. Those numbers make no sense. And then also, does the advisor understand cycles? Are they tactical in nature? And if they're not, I think the clients and the advisors are going to be in for a bad outcome. We're trading it today, the markets are at 200% of GDP. Last time we saw this was 1929. Japan saw this in 1989. And Japan had a flat market for 30 years after that. In the 20s, we had a flat market for 25 years after that. So are we in for some tough times? Absolutely. So it's going to be the advisors who are true students of the market, who truly understand the internal metrics, and who are not overpaying for what they're buying. Everyone just automatically buys. They buy. But the key is, how much are you paying for what you're buying, and when are you buying? It's not really what you own, it's when are you buying. For those who bought NVIDIA years ago, that's great. Horrible thing to buy today. Horrible. And we tell people how to doing it every day. So the general consumer wants to do what's on the news, which is horrible. And sadly, the general advisor does a lot of the same mainstream stuff, and today it's very dangerous.
Thank you for that. I would.
That's perpetuated by the CNBC talking heads of the world, that basically, if you watch Fast Money or any of this stuff, I'm not saying that those particular people are bad, but they do talk about the same stuff over and over again, which is tech. Tech represents 35 to 40% of the S&P. So as you're looking at a glide path model portfolio, the average retiree has no clue that they have so much exposure to technology. And yet it's perpetuated by these talking heads that keep talking up prices, to Mike's point.
So I would just close, because we're wrapping up on time here, but I would ask, each of you, what is the one mindset shift or action that you'd recommend for financial advisors in 2025?
Yeah, so I mean, it's easy. You have to be honest with yourself as an advisor and say, okay, I could throw darts at the S&P or the NASDAQ in 2023 and 2024. This is not the year I can throw darts anymore. I need to think differently, and you need to be challenging yourself to get to that place, whether it's through talking to people like myself or other experts in the field, but getting exposure right now to not only gold, silver, but also precious metal stocks is going to generate so much alpha for those portfolios. Even if it was, as we've been talking about, a 1% to 5% position, it could be a meaningful help to clients, I think.
I would suggest they understand the relationship between U.S. equities and the commodities complex. The stretch has never been wider. It was wide in 1999, and it was incredible after that. There was a couple of 1,000% return in the commodities complex from there, and today it's even wider. So if they could just understand that, it would help them in their positioning of portfolios.
All right, terrific. Well, thank you so much, John Feneck, Feneck Consulting, Mike Chadwick, Fiscal Wealth Management. Thank you both so much for being with us today and for having this really insightful, fast-paced, important conversation. Thank you both.
Thank you.
Sorry.